Okay. Yeah. Thank you very much for giving up your lunchtime again. Today I will actually get closer to delivering what was in the prospectus, which is talking about central banking and unelected power. I hope at the end of it, some of you at least, ideally all of you, will see why I talked about the broad things over the past couple of days. I'm going to try and cover quite a lot of material, and I won't necessarily succeed, and I will probably go a bit faster, certainly than yesterday, possibly than Monday. I'm going to start off with a broad statement of how independent monetary policy fits into constitutionalism. I'm then going to go through what I think was a profound change in the nature of central banking and the authority of central banking. I will then get to the practical stuff, monetary policy, regulatory policy, lender of last resort, and I will conclude by talking about self-restraint, and I will contrast and compare the military, the judiciary, and central banking with what I at least think are some quite good quotes from those three worlds, quotes that I use in the conclusions of my book. So as I think I said in passing a couple of days ago, although this argument isn't often made, I think we should think of an independent monetary authority as reflecting our Western constitutional values, in particular the separation of powers. I think an independent monetary authority is essentially a device for avoiding delegating monetary policy to the elected executive branch, given that the monetary instrument can be used as an instrument of taxation. The alternative would be, the other options would be a committee of Congress. Actually, that might be unconstitutional here because it probably counts as an executive power. But in other countries, it could be used. But I'm not sure a committee of the legislature of the parliament is practical. A little bit more realistic would be a return to the gold standard. There would be no constitutional bar to that. I just don't think that full franchise democracies have the stomach for the volatility in jobs and output that would bring. That's a judgment. But obviously, if you do delegate these monetary powers to an independent body, they could be abused or misused, and so the burden falls on design and constraints. Now, here there is a very important point, which, in a sense, this is the challenge that I'm issuing to many economists, particularly the economists in the macro finance field. And I was reminded of this powerfully when I had dinner with a very close friend of mine from here last night. And what macro finance economists typically do is they identify problems in the world, various frictions as they would call them, externalities. They identify the kind of measures that might mitigate or indeed completely get rid of those frictions and externalities. And then, having identified them, they kind of stop, and typically implicitly they say, well, whoever's best at doing these economic policy things should have these instruments. And in macro finance, the debate tends to be conducted that, we've identified a whole range of things that could be done. Let's give all of these powers to the central bank. And I will come to an example of that later on. I think it's completely wrong. So, in my biological lifetime, we have lived through a transformation in the nature of the authority of central banks. I think when I was born, and certainly before I was born, the authority of central banks was essentially based on know-how, what in the book I call, echoing political theorists, pragmatic authority. The authority that comes from being able to solve coordination problems and by having some private information that enables you to solve coordination problems which central banks have by virtue of being at the apex of the payments system, or the pivot of the payment system, as it was described as long ago as the late 18th century by Francis Baring, the founder of Baring's Bank, who came up with the expression lender of last resort. Whereas these days, we don't think of the authority of the central bank as coming from its expertise or know-how, its economic role. We don't see it as organic in that way. We see it as we see its authority as being bestowed by Congress or Parliament or ministers through a democratic process. And believe you me, this is played out for real in lots of countries. It's in emerging market countries, who I'm not addressing today, it tends to leave them in, and I could give examples of this, struggling a bit as the society expects them to perform more roles given their natural endowments than they are formally authorized to perform. In advanced economies, the transition from one type of authority to another has tended to be accompanied with a desire to remove functions from the central bank. And in fact, in my own country, as the Bank of England was independent, roughly speaking, until the early 1930s, and then not again until the mid to late 1990s. And as we prepared ourselves for this during the late 80s and early 90s, we stopped doing things voluntarily. We stripped ourselves of functions in order to position ourselves to look more like the kind of body that Parliament and the executive branch might give statutory independence to. And then when independence came, banking supervision was taken away and some other functions as well. And this can be awkward when the zone of the institution's natural authority extends beyond its statutory authority and legitimacy, because society expects the authority, expects the organization to do what it can, which essentially is to reinvent itself as the US cavalry. And if this sounds impractical, it's for real. So it absolutely, it both characterizes and, in my view, pollutes the debate about whether central banks should also be supervisors and regulators of the banking system. Now, there's a solution adopted in Japan and Germany, which I don't think is a durable solution at all. So the Bank of Japan and the Bundesbank are not statutory bank regulators and supervisors. It's just that in Germany's case, Bundesbank presidents would say it's very important that they do not have this role. It is also a fact that most of their staff work on banking supervision rather than on monetary policy. And I once asked, there's a footnote in the book on this, I once asked a famous president of the Bundesbank, probably the dominant president of the Bundesbank in terms of its ideas over the past 40 or 50 years, why they weren't a supervisor. And he said to me, it was a he, well, because we can't have the formal responsibility because it would blur accountability with monetary policy. And my response to that is, well, certainly in my country and in the United States, and I suspect in Germany, that if they really screwed up, the lack of formal responsibility would not protect them, because society knows that actually they're doing a great deal of the job. And where you have de facto power in today's world, it needs to be properly formalized. So let me get on to the substance, and let me start with monetary policy. And I want to read what I think is the most eloquent current critique of an independent monetary policy. And this comes from my colleague and friend, Larry Summers. And in fact, it came from an exchange that he and I had. I asked him if he could put down the essence of his critique for my book. It's one of the chapter headings. And I'm going to read it to you. Central bank independence had, past tense, a specific justification. Monetary policy was thought to have major dynamic consistency issues, that's inconsistency over time, and did not have much non-technical political content, not massive trade-offs about the long run. In today's world, where the dominant problem, economic problem, is too little, not too much inflation, the dynamic consistency argument loses its force. And the greater salience of exchange rate issues, fiscal monetary cooperation, and credit allocation aspects of monetary policy draws it closer to policy normally delegated to democratic institutions. So at a minimum, central bank independence needs reconsideration, and it's possible that it can no longer be justified in its current form. And I'm going to offer a defense. I mean, actually, that's quite a moderate statement. And I mean, he and I end up in the same place as thinking that agreeing that we have to think carefully about why this independence is warranted. And also that it's good to talk about it. Another friend of mine, Andreas Domret, said at the end of 2016, it's important that central bank independence isn't debated. And my reaction to that was, my God, these are the last people on the planet who need safe spaces to protect them from criticism and debate. If you sit at the summit, that's what you have to live with. So I think the defense of monetary independence is that it goes beyond the strict time consistency problem, and therefore, in kind of more familiar speak, it goes beyond the worry that a non-independent monetary policy would lead to systematically higher inflation. In fact, the reverse is true as well. I would suggest that had we had political monetary policy after the crisis, it would have been difficult for politicians in some countries, including this one, probably including my own, including Germany, to provide the amount of stimulus that was provided. And the reason for that is that it was unpopular with a certain part of the electorate, people that live from the income, to a significant extent, live from the income on savings. And those people have a very high propensity to vote. And people who have a very high propensity to vote tend to weigh, understandably, heavily in the calculus of elected politicians. I also think, and this isn't quite the same as the inflation bias point, I also think that had they tried to provide a lot of stimulus, they wouldn't have been trusted to provide only that stimulus that they thought was necessary to regenerate the economy. You know, while you're at it, why not inflate away some of the government debt? Why not go further? And even if they're not planning to do that, that could have pushed up bond yields a long way, meaning that the stimulus delivered wouldn't have been as potent. And then, of course, there's the constitutionalist argument that I offered earlier. So I'm not prepared yet to give up on an independent monetary policy. It's worth saying, though, that kind of arguing for monetary independence in some kind of principled way and explaining why it happens in the real world are different things. And I want to run past you an argument that I think the political scientists get almost completely wrong. It's not that what they say is never true. It's that they hold that it's largely true, and I don't think by any means it's always true. So the standard story that political scientists will tell is that, that there are two parties, let's say. One's conservative, party with small c. The other one's a kind of social democrat party, small s, small d, so left, right and left. And the right-wing party is associated more backed by finance, and the Social Democratic Party less backed by finance. And people in finance don't like inflation for lots of reasons, and so the right-wing party, when they're in government, will deliver central bank independence and will try to embed it as far as they can so as to serve the interests of their constituencies and backers, which is kind of pretty persuasive, actually. It sounds right. The difficulty with the argument, and it is sometimes true in practice, is that, of course, there's more than one election. And no party, no politician I've ever met in any major democratic country has expected to be in government all of the time. They expect their party to lose occasionally, but they want their party to get back in. So if you are running a party or at the head of a party, the heart of a party, who thinks, well, if we are responsible for monetary policy, we probably won't do it very well, But what I'm confident of is that the other lot, the left-wing people, will do it a lot worse. And they will do it a lot worse because they prefer a bigger state, and they won't have the courage to raise taxes, so there'll be more debt, so there'll be more inflation, and that is what will get us back into power. So if you're a Conservative Party on this story, you do not want central bank independence. You're certainly not prepared to grant it yourself, because you want it's your part of the device by which you get back into power. I think this is a pretty good description of the United Kingdom since the Second World War, but not only the United Kingdom. And of course, it was the Labour Party that gave the Bank of England independence in 1997. So why didn't the Conservatives then repeal it? They voted against it in 97, 98, but why didn't they repeal it? And I think the reason for that is because actually it brings real benefits, tangible benefits. It reduces the inflation risk premium, which is a real saving that they can then give tax cuts to their supporters. The Labour government can give high spending to their supporters. So once it's been delivered by one party, if there is a real saving, that benefits everybody, and the next party in doesn't want to get rid of it. So that's what I have to say about kind of monetary independence for the moment. The big thing that changes all of, had we been standing here 10 years ago, 15 years ago, and actually had it been someone other than me, that will probably be the end of a talk of central banking, and I'd now talk more about how to do monetary policy in practice. And what it admitted, that worldview, is that we have a special type of banking system. We have what's called a fractional reserve banking system. I'll come on to what that fractional reserve means. And the most important thing to be said about this is that most of the money that we use as people and as businesses is issued by commercial banks. And what this does, it's separate. I mean, whereas we could have a system where all the money that all of us use was central bank money, but then central banks would be in the business of lending to us and lending to businesses as well. And what the banking system does, it essentially separates the allocation of credit from the state. And when people are thinking about the position of the banking system in our societies, it's important to hold on to this principle that actually we don't want the state on the whole, it turns out, to allocate credit. We want that to be done by the private sector. But these private sector institutions are fragile because their liabilities are short-term. They can be called on demand, and their assets are liquid and opaque, so they are subject to runs. And as I said 2 days ago, Doug Diamond, who's in the first row for the last couple of days, wrote the single most important paper in economics on this. And this brings in the monetary authority as the lender of last resort, which is essentially a liquidity reinsurance service. And it's interesting to think that central banks aren't just banks, they're reinsurance companies. And I can say, by the way, that this was something that did occur to me, and I said before I was a director of a private sector reinsurance company. Now, my paraphrase from a few years ago of the famous dictum of Walter Bagehot, who was a late 19th century editor of The Economist magazine, is central banks should make clear that they stand ready to lend early and freely, i.e. without limit, to sound firms against good collateral and at rates higher than those prevailing in normal market conditions. So this emphasizes lending to sound firms only, and it's tremendously important, following my principles of delegation, that this kind of function should be given a clear objective and be subject to constraints. Now, so here's the big leap. This isn't the only route to defend central banking involvement and supervision, but it's probably the most important route, and it's the one I'm going to concentrate on today. So here's a statement from a towering figure of 20th century central banking, a literally towering figure, who, thank goodness, is still with us. I insist that neither monetary policy nor the financial system will be well served if a central bank loses interest in or influence over the financial system. Given just a few years after he retired as chairman of the Federal Reserve, and presaging a 15-year period where that's exactly what happened. And in a sense, it is because this happened that we have the financial crisis. Have no doubt that the financial crisis could have been avoided if people had stuck to this principle. And what the kind of difficult thing in terms of the political economy of all of this is how one function leads to another. So we've got a monetary policy function that I've defended in economic terms and constitutionalist terms. And the ability to print money means that you're the lender of last resort. And now the lender of last resort, you need to be involved in looking at financial institutions because you're going to have to judge whether or not they're sound. They're going to borrow from you typically in conditions where maybe you've lost confidence in the supervisors because there's a problem in the banking system. And you also don't want to be lending all of the time to lots of flaky firms. So actually you care about the standard of regulation and the standard of supervision that is exercised by other authorities. So you're going to get involved, or you should get involved. And then my step is, well, given our political values today, that's not a role that should be done in the shadows. That's a role that should be done under formal powers. And not everyone would travel with me on that. But that's the position that I hold on a judgment on what is sustainable in our democracies. So where have I got to? I've now got to a central bank whose objective or purpose, mission, isn't price stability in some narrow sense. I've now got a central bank whose mission can be thought of as monetary system stability, where the monetary system comprises both itself, the kind of pivot of the monetary system, and these banking things out in the private sector, which might include the shadow banks that we talked about yesterday or the day before. And this mission would have two parts: stability of the value of central bank money in terms of goods and services, and stability of the value of private banking system money in terms of central bank money. So then we come to the question of, so if it's in the financial stability business somehow defined, how are we going to define that? How are we going to make that monitorable? And one of the things I concluded some years ago and try to defend in the book is that saying to the central bank, manage the credit cycle, prevent asset price booms so that we never have crises is too vague. I haven't seen the people that hold that view. Many of my professional friends hold that view. I have never seen them specify an objective which it would be possible for you to monitor, for you to know whether or not they're delivering what they said would deliver. That doesn't mean that it's not important. This means that by my lights, it shouldn't be in unelected hands. I think we can frame an objective that is monitorable for the resilience of the financial system. Why does the resilience of the financial system matter? Because we want services to be sustained through the bad times as well as the good. I think the degree of resilience that we require of the system isn't something that should be decided by the likes of me, but should be decided by elected politicians. People like me could advise on it, but I think this needs to be blessed, if not formally approved, by politicians. And by the way, in the European Union, it is. It also means, this approach would mean that we would think about the standard role of micro-supervision of individual firms in a different way. That's normally framed in terms of safety and soundness of individual firms. And then nothing much is said about what safety and soundness means. Well, safety and soundness would turn out to be different things. One about in life, one about as the firm is dying, as it were, or in distress. And it would mean that the spillovers from the way they conducted themselves as a live business, or the spillovers from their distress, did not actually severely interrupt the flow of services to households and firms. Now, sometimes when I say this, and this was the discussion I had last night, was will that deal with all of the problems that our economists face? No. No, it won't. There is more than one missing regime, as economists might describe it. So here's a problem this would not deal with. You have a build-up of debt. The likely default rates are never going to threaten the stability of the banking system, the resilience of the banking system, because you've made the banks carry lots of equity capital or whatever. But at some point, the households really have borrowed too much money, and not only are they going to default, they're going to spend less as they come back into line with their budget constraint, and that will slow the economy down. That's not a good thing. And it's quite hard to deal with using normal macroeconomic instruments as and when it happens. And so some of my peers would say, well, we should never let this develop. We should spike the household debt bubble before it goes too far. And my quibble is not whether or not that's a good idea. It might be a good idea. My quibble is with the word we. When they say we should stop that, I would say I'm absolutely fine with politicians doing that, possibly politicians advised by central bankers. But I just don't want central bankers to take on that role unless you can monitor how well they're doing it. And I will come to an example later on, which will, I think, help to persuade some of you at least that this is quite hard. So what we have is what I describe as a money credit constitution. So years ago, a man called James Buchanan, who passed away a few years ago, won the Nobel Prize for economics, advocated that each constitutional democracy should have within its constitutional framework a money constitution. And because money is a kind of very precious thing for the kind of reasons I've described. And I'm saying, no, that's incomplete. People might not like having a banking system, but we've got one, and it is entangled, it's intimately entwined with the monetary system. And therefore, what we need is a money credit constitution. And that would have 5 broad elements. One would be an objective for price stability, a standard of resilience for the private banking system with consequent constraints on the banking system balance sheets, a lender of last resort regime to provide liquidity insurance to sound intermediaries, a framework for resolving fundamentally unsound firms, and crucially, constraints on the central bank's latent fiscal and regulatory powers. And I want to run through 2 of those. So yesterday I talked about the importance of a liberal constraint. A lot of what runs through my approach is more from the Republican tradition of politics than the liberal tradition of politics, but the liberal tradition is embedded there. So what I said was, an independent agency's rulemaking should not interfere with an individual's liberal rights more than necessary to achieve the legislated purpose and objective, what the Germans call proportionality. This would mean, if complied with, this would mean that central banks or independent regulators should not be given the power to set across-the-board limits on loan-to-value ratios and loan-to-income ratios that bind directly on you, or actually bar banks from lending to you. And that's because, well, let me tell you a story which kind of reveals as I see it, where this can lead when you have those powers. So a few years ago, there was a housing bubble in New Zealand. Have I told the story already over the last couple of days? I don't think so. And it was the New Zealand authorities, the central bank, introduced a limit. I can't remember if it was LTV or loan-to-income ratios. Let me say loan-to-income ratios. So they introduced a limit on loan-to-income ratios for new mortgages. And this worked. The housing bubble that existed across New Zealand, it dampened, except one place, Auckland. And so they then introduced a new, tighter set of loan-to-income caps for Auckland. And when I saw this, I thought, well, this is amazing. Were this London or New York? So as well as we tried with the UK, and then we say, oh no, the boom is continuing in London, so we're going to have a London LTV one. except it's not the whole of London, it's only Kensington and Chelsea. And so we'll have a Kensington and Chelsea loan-to-value cap set by unelected people. Except actually, Kensington and Chelsea is quite big. I live in the next door borough, I think, anyway. And it's quite big, Kensington and Chelsea. And actually, not all of Kensington and Chelsea in my story is booming. Only some of it. In fact, only parts of Chelsea are booming. So you're going to have to use, what do you call them, zip codes here? We call them postcodes. And what if the boom is particularly bad in a few streets? Why not actually just name the households? And then you say, an unelected person? And we'd have, well, it ended up, we'd have difficulty with an elected person doing that, given our liberal values, but it kind of feels wrong for an unelected person to do it. So what's the other part of this proportionality test? Well, if it's more than necessary. And actually, after I'd left the Bank of England in 2014, they came up with, I thought, a very good solution to this, which is they introduced a limit on the proportion of banks' mortgage portfolios that can be accounted for by high loan-to-value mortgages. So still can have some. I mean, there aren't very many, don't know how many people in this room, but for a big bank, you could all have high loan-to-value ratio, loan-to-value mortgages, and you could all default on them. It wouldn't make any difference to the stability of the banking system, but the liberal freedoms of individuals would have been recognized. Sadly, from my point of view, later on, they were given precisely the power that I think they shouldn't have. The other area is balance sheet policy. And I just want to highlight two things. I think that this is the world of quantitative easing and credit easing and central banks buying all sorts of bonds and doing all sorts of incredible things, many of which, of course, I was not just associated with, but some of which I drove. I think central banks should be as parsimonious as possible, consistent with achieving their objectives. And the reason for that is I think they should do as few things as possible so that you can see what's going on. Whereas when you've got, when you're running 4 or 5 or 6 or 7 types of intervention, all in the credit system and the monetary economy, it's quite difficult for you to evaluate what's happening. And you don't need to do that in normal time. The other thing I would highlight is that when a central bank is permitted to purchase or lend against private sector paper, I think it should be kind of across the board rather than favoring certain sectors. And the selection of individual instruments should be as formulaic as possible. So on this view, again, this has practical consequences. On this view, it is problematic that the Federal Reserve can and does intervene in the mortgage market, but can't intervene in the market and business securities. Either all or nothing would be better. There's also a question about the size of central bank balance sheets, which is topical because they're currently very, very large. And compared with before the crisis, actually this was true in the Bank of England before the crisis, but in the United States, it's only true since the crisis. Central banks pay interest. They used to take deposits from banks called reserves and would pay no interest on them. Now they pay interest on those reserves. And crucially, this means they've got free policy instruments. They could independently choose their policy instrument, the interest rate you will see announced each 6 weeks or whatever it is, the size of their balance sheet and the composition of their asset portfolio. And my principle of parsimony means that they should use as few of these instruments as possible. And in particular, as the Federal Reserve's balance sheet normalizes, I don't think the Federal Reserve should stipulate the size of its balance sheet. I think it should be endogenously determined by the banks themselves, choosing the level of reserves that they wish to hold at the Fed. Now I've got 2 more slides, I think, and I want to talk about self-restraint. So I hope you enjoy these quotes as much as I did when I encountered them in my life, 2 reading, 1 actually sitting in the room, as it was said. So the first is from a man called Field Marshal Alan Brooke, speaking to a colleague after having a row with Winston Churchill during the Second World War. And probably not many of you will have heard of Alan Brooke, but many of you will have heard of George Marshall. And Alan Brooke was the chief of the defense staff in Britain. And he was a very, very great man, as of course was Marshall. And he and Churchill fought like fury. And there was a day where they had actually had an argument all day. This is recorded in one of the best books I've ever read about group decision-making and strategy called Masters and Commanders. It's about Roosevelt, Marshall, Churchill, and Brooke. And they had a terrible row. And Churchill's military chief of staff, or chief of the defense staff in Churchill's prime ministerial office, who later went on to head NATO, quite a big man himself. He goes to see Alan Brooke and says, the old man's really fed up. He's really, really fed up. He thinks you hate him. This is during the Second World War, okay? So that, they're dealing with real issues. And Brooke says, I don't hate him. I love him. But the day I say that I agree with him when I don't is the day he must get rid of me because I am no use to him anymore. Bloody hell. The second one is from Alexander Bickel. I think you say it that way, who was a Yale law professor and wrote a book in the beginning of the 1960s about the importance of self-restraint and care amongst the judiciary. I think it's called the least dangerous branch. And he says the justices have their being near the political marketplace, in which the effects of their judgments are felt. A number of controls are built into their craft, which they practice under the scrutiny of a profession, the legal profession and legal scholars, whose expectations and approval must matter to them. And then Mervyn King, my former colleague, who spoke at a retirement dinner for Jean-Claude Trichet, the former president of the European Central Bank, in London in 2011, when Jean-Claude was retiring and Mario Draghi was succeeding him. And Mervyn said, and these are from my notes, but Mervyn has approved my recollection. Central bank governors require three qualities above all: a deep commitment to price stability, well, I would say monetary system stability, an ability to be clear and direct to politicians about the policies that are required to produce economic stability, and the ability to be unpopular when circumstances require. Now, these are the three great pillars of unelected power in our societies today. And those three quotes capture subtly different positions that they occupy in our societies. And from this, I think we can learn, I think central bankers can learn something from the military and learn something from the judiciary. So like the military, but unlike the judiciary, the central bankers must be ready to advise in private on the wider government policies that are necessary for monetary system stability. We don't expect the judiciary to be popping in to see the president or to see the prime minister. We do expect the head of the army to be doing that, and it's okay for central bankers to do it. Unlike the military, precisely because central bankers have job security, which military commanders do not, central bankers must not press and press while not equivocating in their advice. The day that Brooke and Churchill had that row, and it was kind of one of many, Brooke would just carry on. He would just carry on. No, you're wrong. You're wrong. You mustn't do this, or you must do that. And you can do that if you can be sacked. You mustn't do that if you can't be sacked. Deliver your message, deliver it clearly, maybe repeat it once, depends on the circumstances. But don't press and press. Whereas Brooke saw it, and I think he was right, almost as his duty to press, as long as Churchill wanted him to be there. Unlike the military, the central banker can repeat this advice in public at their own initiative. We don't expect military commanders to go around doing that. But in doing so, the intimate connection with their formal mandate must be explicit and able to withstand tough scrutiny. And then crucially, they can't be in the business of offering their opinion in private or in public on things they happen to know about or are interested in, but do not rely on in fulfilling the trust placed in them by legislators. So by being given powers, you accept that you are being given a platform that you must only use for your mandate. You must not use it beyond your mandate. Like the judiciary, they must not be drawn into offering specific private advice or public remarks about things that they will or might have to decide. If I do this, what interest rate will you set? The politician asks the central banker. Well, I don't know. Partly because I don't know which way my other colleagues are going to vote. That's not what you expect from the military commander. Like the judiciary as legitimacy seekers, they can, and I think rationally ought to, explain their institution to the public. So although it happened in crisis when Ben Bernanke went on 60 Minutes, my thought was, yeah, that's great actually. I hope Federal Reserve chairs continue to do that so that the American public can see who these people are and see that they're human. And like the judiciary, they must be ready to take criticism as they're going along. We don't really expect our military commanders to be subjected to criticism in the heat of battle. We actually need to stand behind them in the heat of battle. So the answer to the question of whether or not they're overmighty citizens is for them to internalize that they're unelected Democrats. Thank you very much.
Two questions. The first is irrelevant, but I wonder what the row was about between Brooke and Churchill.
Oh.
If you can't remember, that's okay.
I can't remember.
I guess I'll
remember. I'm sorry.
That's okay.
It was in 1944. It was well, not the very toughest, right. Actually. I mean, the really tough period is when there is a difference between Marshall and Brooke in when to go into Western Europe. That's
tough decision.
Yes.
Got a lot of guys on the beach. So you're talking about the central bankers, and I love the summary of how they should be liked, unlike military or judiciary. But it's sort of, the whole talk takes the elected officials, the presidents and prime ministers, sort of as a given. And you mentioned they're elected. They know that they won't be in power forever.
Yeah.
The other party, the tide will come and go. There's some people for whom that's not true. I think of Maduro, Duterte, Maduro in Venezuela.
Yes. Oh, yes.
Perhaps Putin.
Oh, yes.
But I wonder if you should have any.
So I am. Perhaps this is the difficulty of giving a series of 3 lectures. I am talking only about healthy democracies. I am talking about how people towards the pinnacle of our unelected power should be constrained in order to keep our healthy democracies healthy. And I am worried that the more that we push out of elected hands into unelected hands, who we, the public citizens, can't vote out, that when inevitably an area of policy goes wrong, as it will inevitably, if that's happening all over the place because we put everything in these unelected hands, the people will say, well, what does it mean to have these elections and vote them out? Actually, the people that are taking the big decisions that affect our lives, they just carry on. But it's only about healthy democracies. I think the interesting question actually is how my principles would apply when you get something that kind of almost is, and the answer to that is I don't know.
Thank you, Sir Paul. I have a question. So now you've done all this studying. So where are we right now? In other words, on a scale of 0 to 10, 10 being metaphysical adherence to what you think is the ideal, and 0 being a democracy loss, where are we?
This is really
points in different countries.
Well, first of all, thank you for coming again. The reason I'm laughing is there's no one in the room that served in office with me from around the world. This is one of my favorite questions, I'm afraid. And I was recently at a conference in Europe where I marked various policies from around the world against 10. So, oh my goodness, I can't believe that I'm not prepared for this question, but I'm not. Here, five. So I'm going to take that as a benchmark. The UK, better than 5 in some fields. I think better than 5 actually in central banking. Less than 5 in other fields, because something I didn't describe, because this is in Chicago, is the UK has lots of independent agencies with just one head and one policymaker and lots of vague goals. And I think they need to be on some kind of political leash, even if it is only an annual budget approval going through politicians rather than kind of being able to take decisions, politicians taking decisions. Germany is almost impossible to mark for the reason that I gave on Monday, because they would say, well, we don't have any independent agencies, and I would have said, well, actually, you do de facto. Will you please face up to that? So, in a sense, I want the German their essay paper wasn't accepted for marking, and I think France better. In fact. I think not so 20 years ago. I think that of the countries I researched, they seem to me to have thought most carefully about how to box independent agencies in. I don't think that's a very adequate answer to your question. As I said, I can't believe that I haven't thought of, given how fond I am of your question. Thank you for it. At the back over here.
Thanks for the lecture, Paul. It's fascinating. So I just wanted to, this is quite a UK-specific question or a European-specific question. I just wanted to get your view on how an institution like the civil service factors into this. I don't personally know how it works in the US, but and not only in the UK, but perhaps more so in Europe, where the European Commission, which is modelled in part on advanced civil services, seems to have huge power in writing, designing, and coming up with legislation. And I'm just wondering also, how you kind of tie that all in with, I suppose, Brexit. One interpretation of Brexit was as a reaction against unelected legislative power on the part of something that looks like a civil service bureaucracy in Europe. So it's quite, it's interesting in your views.
So I will say something about the EU. So I talk about that in my book. The civil service thing, because in my book I cover the United States, UK, France, Germany, and the EU. In each case, to try and, it's already a long book, to contain it and try and keep the things that are more or less recognizable across jurisdictional borders, I omit some local specificities. So in the United States, I omit federalism. And actually, I think the relationship between the federal government and the state government is important for the issues that I've been describing. In the UK, I omit the civil service. I think there is a really interesting question to which I don't know the answer, is whether the attitudes of mandarins to independent agencies is the same as the attitude of ministers to independent agencies. And in a sense, I would like social scientists in the UK to explore that. My guess would be that they're not. I think the most articulate critics of Bank of England power tend to be former civil servants. And the interesting question, like always with mandarins, this is a mixture of their long experience and sophisticated understanding of how the system works, and of course that independent agencies take power away from the mandarins. That's what independent agencies partly do, because mandarins advise ministers. The EU thing, but those are ill-formed thoughts which I haven't explored. the EU is a very interesting case for all sorts of reasons. As a matter of, there are things called independent agencies, or that are referred to as independent agencies in the EU. And this is a kind of remarkable thing in itself, quite new, because unlike in the United States, there is a doctrine of European law that comes out of a case, I think in the early 1960s, maybe late 50s, called the Moroni case, that basically says, has the effect that you can't set up an agency, an independent agency, with rule-making, rule-issuing powers, but all such rules have to be issued by the European Commission itself. And so what these agencies now do is they have the power, the formal power, to make formal recommendations on what the detailed rules should be. They then go via the Council of Ministers, and these are so-called level 2 powers for those of you that are European. They go by the Council of Ministers and the European Parliament and are subject to veto there, but finally they are issued in the name of the Commission. And what can't be seen, whether the Council or the Parliament veto, is visible to you. What cannot be seen is the influence of the Commission. And so you have one bunch of unelected people being arbiters over another bunch of unelected people. But this is merely one of many dimensions of the challenge that the EU faces, which is an incomplete constitutional project. And I would say any one thing about Brexit. I don't think it was, for some people, it was exactly what you described. For other people, it was more the European Court of Justice and the power of a court, where given our traditions of parliamentary democracy, our courts have tended to be more restrained than the ECJ. But I think you're absolutely right. I mean, the EU has more challenges than any of the other jurisdictions I've discussed. And the ECB I think the ECB is a fourth branch of government, even though very technically it is a smidgen below the 3 or 4 main institutions, if you count the Court of Auditors. But when the euro area was imploding, there was only the ECB that could underpin the whole project, and it did so, and nobody could possibly have stopped it had they wanted to.
Hi, I'm curious, to what extent do you see potential for a paradigm shift in how some of the traditional metrics like inflation are interpreted and understood, especially in light of the internet making distribution of goods more efficient and increasing services that are essentially free for consumers?
Well, paradigm shifts are quite rare, actually. I mean, I don't know how many people in the room have read Thomas Kuhn's book, but it's absolutely magnificent. I haven't seen so far the new technology fundamentally change the way that we think about the world. It's plainly going to deliver all sorts of changes to the way that we live our lives. It might. Technology in slow motion can change how we think of ourselves as people. I don't see it doing anything dramatic to the measure of inflation, except perhaps for one thing, which I think that goods that have a marginal cost of 0 are very difficult to take account of in measures, in money income-based measures of welfare. But that is going to probably take us into techie territory beyond why most people turned up. Indeed, myself even.
Hi, I'm wondering what you see in terms of the political economy of central banking, or the role of academia and the media going forward. So there are obviously other players in the game, and a lot of us are in that category.
So, 2 or 3 things. In my book, and in passing over the past 3 days, but only in passing, I've talked about the importance of public debate. Public debate doesn't happen spontaneously with some central banker standing on the steps of their building and addressing the nation or the or the world. It is intermediated via people in office, bloggers, public intellectuals in countries that have them. Not sure mine does. Academics. I think this is tremendously important, and it has one very important implication for central bankers themselves. Is central bankers and other unelected independent regulators need to address each of those communities, but they must also always do so consistently without changing the message. So if you sit in Chicago econ seminar rooms, you need, and you speak about how you approach monetary policy, it needs to be consistent with how you would describe it on television. It really does. There can't be one story in the seminar room and another story for the people, even though it's obviously going to be different degrees of technicality. That's hard to do. I've seen one man do it absolutely brilliantly, he's great. One of his great gifts is to be able to just shift around in his register without, as far as I could see, changing the substance. I didn't always agree with what he said, but that's a different point. The media is also important for kind of real-time scrutiny. I place a great deal of emphasis in my book on congressional parliamentary oversight, testimony, healthy testimony. And there's a section in the book that compares testimony in Congress with testimony in the Westminster Parliament. And minority votes help to focus those debates, but most of all, kind of the media helps to focus those debates. I mean, the Financial Times will typically say ahead of a monetary policy hearing or a monetary policy press conference, the 5 questions that people should be asking. I mean, they're not always the best questions, I suspect, but they're going to be pretty good. The one other thing I would say is, I think, and this is everything I've said so far, I think goes for all independent agencies of any kind. I will say something specifically about central banking. When I look back, and this was true of me, when I look back, the dialogue was too much between central bankers and economists. Occasionally, international relations people as well. But there are endless conferences. I mean, this is one of the great things about central banking that other agencies, other fields don't do as well, I think. I mean, academia is allowed in, but it tends to be the economists. Well, what about political scientists? I went to a conference in Cornell on central banking that was sociologists and anthropologists and political scientists. And there were 3 of Alan Blinder, Adam Posen, and I were the 3 people from my tribe. And it was stimulating and great. And people are suspicious if they're not allowed in, and there's no reason not to allow them in. You kind of breed your own conspiracy stories if you close the doors on people. And that's always been true, actually. And when I look back, particularly when I was a member of the board of the Bank for International Settlements, I wish I'd said this. I wish I'd thought it, and I didn't. I think we are done. Thank you very much for attending.